levels where prices then stop and reverse direction. So for example, a resistance level, when we're down resistance level, is a price level where the price tends to move up, and when it reaches a level, it tends to stop and reverse back down. Okay, again, it goes up, reaches a certain level, goes back down, goes up, reaches a certain level, goes back down. That is known as a resistance level, or like a ceiling. Okay, so this is the resistance level. So why does resistance happen? You can understand the psychology behind resistance is that at this price level, for example, this could be 1.2850. As you can tell, that's my favorite number. Okay, you can buy the lottery on those numbers. At this level, it tells you that supply exceeds demand, or in other words, there are many sellers that are queuing and waiting at 25 or 2850. So the moment the price goes to that level, there's a probability it will stop and reverse back down. That's known as a resistance level. So conversely, what's a support level? A support level happens when the price goes down and reaches a certain level, stops and changes direction. Goes down, hits the level, changes direction, goes down, reaches the level, changes direction. And that is known as a support level, or like a floor that supports the price. So say this support level is at a price of 1.2800, for example. Okay. So again, why does this support happen? Psychologically, it's because there are many buyers that are queuing at 2800. Demand exceeds supply at that level. So the moment the price goes to that level, there's a probability it will stop and reverse back up again. So that's the psychology of support and resistance levels. Okay, so the first question would be, how do you know when a resistance and support level is reliable? Okay, so one of the measures I use is I want to ensure that a resistance level or support level is tested at least 3 times for it to be reliable to use. So it means the price must go up to a certain level, and it goes to a level, it comes down, that's what we call one test. Goes up again to the same level or close to that level and reverses down, that's test 2. Goes up, comes down, test 3. So again, I want to see a level tested at least 3 times for it to be a significant resistance level. If it is tested 1 and 2 times, it is a potential probationary resistance, but the third time is the confirmation of resistance. Similarly, for support, it has to be tested at least once, twice, and preferably again 3 times for it to be a reliable support level. Okay. Now, some people say, Adam, besides horizontal support and resistance, there are also trending support and resistance on there. For example, you have a trending support line, or a trending support line, or trending resistance lines. Yes, you could draw them, but I do not draw them because I find that trending support and resistance, the ones that are diagonal in nature, are very subjective, and you see what you want to see, and 5 different traders will draw it very differently. And if it is not that objective, it's very subjective, I don't find it reliable. So personally, I only trust horizontal support and resistance levels, especially for currency trading. The other thing to understand is that when I say it's reliable, it's a matter of probabilities. So once there's a resistance, for example, at this level, at 2850, it doesn't mean that if the price goes to 2850, it must stop and come down. Okay, as you know, in trading, there's no guarantees. There are no guarantees, there's no certainty. It's only a probability. So there's a probability it will stop and come down, but it's definitely not a certainty. Okay, so as traders, we want to take high probability entries. In other words, we want to buy when the price hits a support level that is strong, and we want to buy at support because there's a probability it will go up and we can make some quick profits in pips as it goes up, right? So we want to buy at support levels. Okay. Similarly, when a price goes up and hits a resistance, we want to be a seller at that level. So we're going to sell at resistance, we're going to buy at support. And this is especially so for the strategy on trade the range, which is one of the strategies we learned in this course. Okay? So again, if you sell at resistance, it's not a guarantee it will come down. It can always break the resistance and go up. If you buy at support, it can break support and go down. So it's only a probability. And as you've learned in course 1, you can't be right all the time, and you don't have to be right all the time. As long as you are right half the time or slightly more than half the time with a good risk to return ratio, you'll be very profitable. So when you're wrong, you lose 1 R. When you're right, you make 1 R. You make more than 1 R, right? You make 1.5 R or 2 R, and that's our whole point here. Finding areas where there's a probability of a price reversal. So that's resistance and support levels. The other important thing to understand about resistance and support is that it is not a defined line per se. It's more like a zone. Okay, more like a zone. So what do I mean? Let me draw it one more time. Okay, so a lot of people think that resistance is a line like that. That's resistance, right? Resistance. And support is, again, another line like that, support. And they think that prices move within these two lines like a brick wall, right? Goes down, hits the wall, goes up, hits the wall, comes down. Yeah, only in theory. In reality, this rarely ever happens. Okay? So many times what happens instead, let me just redraw that. So in reality, what happens more often instead is that this line is more like a zone, which means the price can go up and it doesn't exactly touch and come down. It can go a bit above that and come down. Similarly, it may touch support here, go up, and sometimes it may not even reach that line. It may fall short and come down. And again, it doesn't stop exactly at that level. It could pierce below that level and go up. And like so. Okay? So when you use support and resistance, always understand that it's more like a zone. Doesn't exactly touch the point and come down. Okay? It can go beyond that point and come back down. Beyond that point and come back down. Right? So like a zone over here. So you got to always give a buffer. Okay? So for example, if the price comes down here, right, and you buy, for example, you buy here, and you think, hey, this is a support, it's going to go up, right? I'm really certain it's going to go up. So what do? You buy over here, and you place your stop loss here, for example. Okay? Sorry, let me do that again. Okay, let's use this example, right? So the price is coming down, coming down, coming down. You say, okay, it's going to hit the support. It's going to bounce, right? So I'm going to buy at that level. So I'm going to buy there. And you're going to place your stop loss below that support level. Like, most people teach in most books, right? But the trouble is the market likes to screw you. Okay, so what happens is you buy there, and sure enough, it will go below the support. It will hit your stop loss, and you end up selling for loss, right? You bought there, you sold there for loss, and the next thing you know, it goes up again. And you go, damn, what happened, right? The market's out to get me. I'm really unlucky. No, it's not that you're unlucky. The market's not out to get you. That's how the market is. So you have to ensure that if you buy there, you have to give buffer to the fact that the price will continue going lower than the support by a buffer, by a zone. So you must ensure that you place a stop loss far enough away to give it some room to go beyond the support and bounce back up again. Of course, it can still fail. I'm not saying it's going to definitely go up, but you have to give some buffer. Similarly, if you do a sell over there, if it's going to resistance and you're saying, okay, I'm going to sell over there, right? I'm going to sell over here, okay? You have to put your stop loss far enough because the price will not stop exactly there all the time. Sometimes the price will go a bit beyond that resistance and come down. So you've got to give a buffer. You've got to emphasize, you got to give a buffer zone. All right, now you may say, okay, how much is that zone? How much buffer do I give? In general, I would say between 8 to 12 pips. Okay, 8 to 12 pips. If you're trading the 15-minute candle charts, which is the time frame which I normally trade. So obviously, if you're trading the hourly charts or daily charts, then it'll be very, very different, right? So it depends on the time frame. So for 15-minute candles, 8 to 12 pips is the buffer which I give. And you may say, why 8 to 12 pips? I'll explain it in a short while why. Okay, so let's take a look at the charts and see if we can find these support and resistance levels, or how do we identify these support and resistance levels. So again, notice I'm using my MT4 charting software. I'm looking at 15-minute candles. So let me remove these drawings. Okay, and let me start by going to the first pair, which is Euro USD. Okay, now oftentimes you find support and resistance levels when the price is going sideways in a consolidation. All right, so oftentimes when it's in a very clear uptrend or clear downtrend, you don't really see much support and resistance levels as much. You want to see it in a sideways pattern. Okay, so over here you can see that the price is pretty much on an uptrend. Okay, so I don't really look for support and resistance at the level. And again, how do you know it's a clear uptrend? Well, the clue is in the moving averages. And I'll talk about moving averages again in a short while. But just to give you a heads up, right? On a very clear uptrend, you find that the moving averages are sloping up. They are sloping upwards. Okay? And they tend to be in a certain sequence with the smallest moving average on top and the biggest moving average below. So this blue line that you see over here, this thin blue line, is the 18 exponential moving average. Oh, that a really ugly 18. So I'm going to draw that again. This blue line is the is the 18 moving average, 18 EMA. The blue line, the thicker blue line, is the 50 moving average, and the red line is the 200 simple moving average. So it's exponential, simple moving average. Now this red line is the 6 moving average, so 6, 18, 50, 200. Okay. Now for the advanced strategies, I'll be using mostly the 18, 50, and 200, not the 6. Although we use the 6 a lot in the impulse pullback and impulse pin bar strategy in the basic course, but for this course, I'll be focusing on the 18, 50, and 200. Okay. So again, notice that on a very clear uptrend, the 18 is above the 50, and the 50 is above the 200, and they're all sloping up in sequence, 18, 50, 200. That's a very clear uptrend. Okay, so that's how you identify a trend. I'll talk about it again later under moving averages. Okay, so I want to find a period when the price is moving sideways. Again, you can see it's a very clear uptrend here. All right, clear uptrend, sloping up, sloping up, sloping up. Okay. Now over here, let me zoom out a bit. Okay, over here, this portion here, can you see that it's no longer on a clear trend? It's no longer on a clear uptrend or a clear downtrend. And a clue is when the moving averages are not sloping up nicely or not sloping down nicely. They're kind of like, the moving averages are kind of like moving sideways and they're crisscrossing each other. All right, so the blues on top of the red, the blue crosses below the red, goes above the red. It's kind of like, it's like crossing each other like that. Can you see my hand gestures? Okay. So the moving averages are moving sideways and crisscrossing. The price is pretty much in a consolidation phase, moving sideways. But when the moving averages are sloping up in a very nice sequence, like a rainbow, right? 18, 50, 200 is an uptrend. Okay, sloping down. 1850, 200 is on a downtrend. So this is a sideways pattern, and sideways pattern is when the support and resistance levels are very, very clear. Okay, so let's see if you can identify how do you draw them. So using the charting software, I click on this line here, which is the horizontal line. Okay, and again, I can double click and I can move it and place it where I find a resistance or support level. Okay, so I would place it somewhere there. Again, I can zoom out so I get a better look at it. Alright, okay, I'll place a resistance somewhere here. Oops. There we go. Okay. So why do I place a resistance over here? Some of you may ask, okay, why don't you put a resistance here? Why don't you draw it here? Or why don't you draw it here? Why do you draw it here and not here and not here? What's the reason? Well, I like to draw the resistance where it touches as many points as possible. I draw the line of best fit. Okay? If I draw it here, it only touches once. If I draw it here, it only touches twice. But when I draw it here, notice it touches once, twice, 3 times, 4 times, 5 times. Touches 5 times. So it's a more reliable level, all right, because it touches as many points as possible. So I would take that as a more significant line than the first two. So I can double click on this and I can just delete it. Delete, double click, right click, delete. Okay, so I find there's a resistance over there. And where would I draw a support? I would draw it somewhere here. Why? Because again, you can see that, to me, I can see it's pretty significant, right? It's tested more. Okay, so you can see it went down. This is 1 test, 2 tests, 3 tests, 4 tests, 5 tests, 6 tests, right? So it's tested many times. It's a significant level. Okay, so that's where I draw my support. Now, why wouldn't I draw the support here? Well, actually, you could. This is actually another support level, right? You can see it's tested once, twice, 3 times, 4 times. So this is also another support level. So that's 1 support here and that's 1 support here. Remember, as long as it's tested 3 times, it's a reliable level. Well, to me, at least. Okay, reliable enough to use to make trading decisions. Okay. All right. So taking a closer look, notice. Let me zoom in a bit. So notice what I mentioned about buffer zones, right? So you can see the price goes up, hits the resistance, comes down, goes up, hits the resistance. Again, notice it doesn't stop exactly at the point 1879. It in fact goes a bit beyond that point, comes back down. Then goes to 1879, comes down, comes down. So notice that this is the buffer zone. Okay? So as it went up, you may say, hey, I'm going to put a stop loss above that. It hits your stop loss and it goes down. Okay? So again, there's a certain buffer zone you have to be careful about. It can go beyond that zone. Now, again, I mentioned that roughly how much buffer do you give? You give about 8 to 12 pips for 15-minute candle time frames. Okay? Now you may say, why 8 to 12 pips? Well, it is really based on a concept known as ATR. ATR means average true range. Average true range. And this means what is the average range of the candles for that time frame. Okay? So normally I look at the ATR of the currency pair and I take 2 times ATR. Alright? But through experience, I usually just take 8 to 12 pips. But if you want to know why, look at 2 times ATR. Now, how do you get this ATR thing? Well, what you do is go to indicators. rather go to Insert, Indicators, select that. ATR, Average True Range. Can you see that? Okay, so you click on that. And by default, it's 14, so leave it as 14. Click OK, there we go. So can you see ATR over here? So this blue line tells you the average range of the candles. That means what's the average length of the candle? Yeah. So you can see, give me a second. Oops. There we go. All right, good. So notice that it goes up, it comes down, it goes up, it comes down, right? So you may say, which one do I take, right? Well, normally what I do is I take roughly the center. Okay, so that's the top. Can you see that's the top? And that's the bottom. So the center is somewhere around here. That's the center, right? It's just an approximate, okay? So notice the center is about 6. Can you see 6 over there? Let me just bring it closer for you. Can you see 6? That means 6 pips. So it tells you that the average true range, the ATR of this currency pair for 50-minute candles is 6 pips. So what is 6 times 2? Ta-da! 12, right? And so because of that, I know that during this period, I should give a 12 pip buffer, which means my stop loss should be at least 12 pips away if I'm going to sell or buy. All right, so that's how you can check it more accurately by using ATR or average true range. So let me get rid of this. Let me just delete that. Okay. So if you take a look from here to here, if I click and I drag, there you go. Can you see 12 pips? All right. By the way, you see 120, right? You see 120? That's 12 pips. Okay. This is 10 pips. So ignore the last digit. So when you see 118, it means 11 pips. Okay. So what this is telling us is that the price moved roughly about 12 pips above its resistance as a buffer. That's what it means, right? So that's the resistance. This was about 12 pips. 12 pips, right? So it went up, came down, right? So like I say, give the buffer between 8 to 12 pips, right? And again, through experience, you can tell which one to use. But if you want to use the ATR, look at the ATR, take the center of the ATR, multiply by 2, that tells you the buffer zone you need to use. All right, guys? Okay. Now, the other concept to understand in support and resistance is that support becomes resistance and resistance becomes support. Okay, so this means that if you have a resistance line here or zone, I call it zone, okay, and the price goes, hits the resistance, comes down, hits it, comes down, hits it, comes down, and if it eventually breaks above that resistance and it comes back down again, oftentimes, doing that previous resistance, okay, will tend to become support. So this is test 1, okay, test 1, test 2, test 3, test 4. So this is considered a test of that level as well, okay. Similarly, if this is a support level, and the price goes test 1, test 2, test 3, and it breaks that level, what happens? If it comes up again, oftentimes that support will become a resistance, and goes down. Okay? So there are traders where what they do is they look at a resistance level, and when it breaks above the resistance, they wait for it to come back down again, and when it hits that resistance that turns support, what do? That's right, they tend to buy over here and run it up. Now, this is a strategy that I don't use that often, but it is used by some traders, right? So similarly, this is a support level, right? Test 1, test 2, test 3, breaks the support, goes, hits resistance, comes down, and that's where traders go short. All right? So let's take a look at that phenomenon on this chart. Do we have that phenomenon? Okay, so as you can see here, this resistance broke out and became boing, boing, support. Can you see that? So this resistance level has become a support level. There you go. So this tells you that this level here at 1831 is a very strong level because it has been tested on both the resistance side and the support side. Both the light and the dark side of the force has been tested. Very strong. All right. And again, over here, you can see that this level remains powerful because it went down and boom, it went up again. So again, this was a support level. And again, it went down by a certain buffer point, right? So it was a support that then tended to hold. Okay. And you can see it held here, support, boom, support, boom, again. Can you see a very strong support here? So the more the support is tested, the stronger it is. Okay, so again, in the trade the range strategy, I'll teach you when do you buy at support, when do you put a buy order at a support. So the moment it hits the support, right, you are in the trade as it goes up. All right. So again, it doesn't always work. It's not 100%. It's a probability. It tends to respect the support and resistance more than half the time, and that's all you need to make money. Right. So again, you can see how this works. Okay. There we go again. Notice the strong resistance. It breaks the resistance and boing, it becomes support. Can you see resistance becomes support? All right. Now, do also notice that it is useful to draw these support and resistance levels because, again, whatever strategy you're using, always remember this. Never buy right below a resistance level. Okay, never buy below a resistance level. So, for example, if you know there's a strong resistance over here, okay, and you get a buy signal here, it may be better not to take the signal. Because you could buy here, it goes up, before reaching your target price, it comes down, okay, because of a resistance. Similarly, do not do a sell or short near a support level. Alright, so for example, if you identify that there's a support here, a strong support level here, and you see a sell signal here, for example, you say, hey, there's a sell signal, or whatever strategy you're using, then it's a bit more risky, all right? I mean, you could still break the support and take a profit, but, you know, there's a higher probability that you sell, it goes down, it finds support and goes up, and it hits your stop loss, okay? And so that's why these support resistance levels are crucial to draw, to help you make better entry decisions. All right, let's take a look at more examples. So now let's look at dollar franc. Again, on the 15-minute candles. And you can see, is it a clear downtrend? Yes, it is, because again, look at the moving averages. They're all sloping down, right? So nicely sloping down. And look at the sequence, right? 200s on top, and you got a 50 over there, you got an 18 over there. So whenever you've got this downtrend sequence, the larger moving average followed by the medium and the small, sloping down, there's a clear downtrend. Okay, so I'm looking for, again, a pattern of consolidation when the price going sideways to identify the support and resistance levels. There we go. Okay, so again, can you see over here, the price is in a period of consolidation. Why? Because the moving averages are going sideways, and they tend to again be crisscrossing each other. Okay, so it's at this juncture where you start to identify support and resistance. Okay, so where would you draw the support? Where would I draw the support? Let me zoom out a bit. I would put the support somewhere to me, this is the most significant point. Why is it significant? Because it touches as many points as possible. Okay, let me zoom out. Can you see? This was a resistance, and support, 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 support. So very strong support. Can you see? Very strong. So 9886, there were many buyers waiting there to buy the moment it reached that price, and it kept pushing the price up, pushing the price up, and eventually the bears won, and the bears broke the support, and once the support was broken, all the way down. Okay, so then it started a new downtrend, right? But at this point here, it was a consolidation pattern, and again, in the trade the range strategy that you learn in lesson, I forget, I think lesson 4, I'll teach you how to buy exactly at the support level and exit at the resistance level, right? And again, you could have made a lot of money here eventually before it broke down. And again, you never know when it's going to break down until it breaks down. Okay, so that was the resistance, a support level. Where would I draw the resistance? Again, would I draw it up there? Would I put the resistance up there? No, it only touched once, so it's not very significant, right? Would I draw it there? Yeah, because it again tested once, twice, 3 times. So that is a significant level, okay? And you could have multiple levels. I would say there's another level over here. Thereabouts. Okay. If I zoom in, again, I want to draw the line of best fit. Which line fits as many reverse points as possible? I would say is this one, right? So resistance, resistance, resistance. It broke above the resistance, then resistance again, broke above it, resistance again, resistance again, resistance, resistance, resistance. Very strong resistance levels. Tells you sellers were waiting there. Buyers were waiting there, okay? So in a very clear range, every time it hits the support and we buy over here at the support level and sell into resistance, we can make a pretty good living taking profits very nicely, right? So buy there, sell there, buy there, sell there, and we call this trade the range, right? So again, it's not that simple. There are very specific entry and exit rules to follow when trading the range to only enter with the best probability. And again, we'll cover all this in lesson 4 of the advanced trading course. So hold on to your horses for now. Just understand the concept of how to draw these lines. That's all you need to know now. Don't worry too much about the exact entry point, the exact exit point. That will be later in the course. For right now, it's just knowing how to draw these levels. Okay, let's look at the one last example, dollar yen. And again, you can see it's a downtrend over there. I'm looking for a consolidation pattern. This is a very small consolidation. Well, you could draw it there. It's a pretty small consolidation pattern. Yeah. It's not really tradable because it's a bit small. Okay. This is a bigger pattern actually. Yeah. So over here you can see pretty much going sideways with a downtrend bias. Okay, and again, I'll teach you about downtrend bias in a while. But overall, it's going sideways with a downtrend bias. Where would you draw the resistance? I'll tell you where I'll draw it. I'll draw it somewhere there. Would you agree? Resistance. There's 1, there's 2, there's 3, there's 4, there's 5, there's 6. Very strong resistance here. All the sellers are waiting at 11335. The moment it hits resistance, you could sell, you could sell, you could sell, you could sell. You can make very nice profits and take profits somewhere at support levels. I'll teach you again in lesson 4 that we only sell with a downtrend bias. We only buy with an uptrend bias. And we'll learn about biases later on in the course. Just hang on, okay? Now there's a very clear resistance in this case, but I don't see a very clear support level. I don't see a clear support level. Let me see. Yeah, I guess the closest would be there. Again, you can see a test of support, test of support, test of support, test of support, right? 1, 2, 3, 4, and then boom, it broke the support all the way down. Okay. So remember, one of the things you've learned in the basic trading course is when a strong support is eventually broken, what happens? It collapses, right? It turns into a new downtrend. And if a strong resistance is eventually broken, it turns into a very strong uptrend. And we call that breakout trading. Buying the breakout of resistance and shorting the breakdown of support. Now, that's not one of my key strategies I use in Forex trading, but there are traders that do that. I don't do that. Okay, it's just not my cup of tea for Forex trading. I tend to use other strategies that you will learn in this course. Okay? So that concludes this part on support and resistance. Let's now move on to the next part, where I again review moving averages. Alright, so if you like this video, you can subscribe for more videos by clicking on the subscribe button. If you'd like to enroll in our professional Forex trading courses, you can go to piranhaprofits.com. For live training courses in Asia, do visit us at wealthacademyglobal.com. This is Adam Khoo, and may the markets be with you.